We definitely did some flip-flopping around in the market, and the sell-off we've had recently and the flip-flopping, I believe, has more to do with market dynamics than it has to do with fundamental reasons for a change in trajectory of the market. The market dynamics I'm talking about are things like rising bond yields. We've heard a lot about this, but why does the market even react to the bond market? People with making investment decisions are ultimately looking for a return on investment. As the return on investment from bonds increases, the yield increases, bonds become more attractive. And that means other assets become less attractive. However, I think things are different in this case, and I don't think bond yields are actually improving in real terms. They are improving in nominal terms. The distinction between real and nominal is inflation. Real considers inflation, nominal doesn't consider inflation. This is particularly important for bonds because bonds give you back a predetermined, at the time of purchase, amount of cash, whereas stocks represent an asset that will adjust based on the market and inflation. So bond yields are taking up, but so is inflation. So in my opinion, it seems as though bond yields are the same in real terms, which in my opinion is what matters. Now, it's possible, and I've heard people discussing this, that bond yields are going to stabilize at this level. David Tepper's talking about this. Some people in Japan are talking about this. The treasury yields exist in a marketplace, and treasury yields are competing against other nations' treasury yields. It just so happens that a lot of other countries, Japan, Germany, etc., have even lower bond yields than the yield of the United States of America with the world's reserve currency, and it's paying the highest interest rate of developed nations. So that should stabilize the selling, considering now there should be more buyers of U.S. treasuries. In addition, I think the market dynamics of bond sellers, people looking at bonds to buy, so stock sellers looking at the bond market as a competing market, I believe that's not necessarily the case in an inflation environment. I think stocks, being the inflation corollary asset, are particularly attractive in inflation. Now, that, I believe, will address the downside risk and the downside story that seems to be taking precedent. But there is high levels of volatility. And I believe this is yet again simply market dynamics and even less fundamental than bond yield changes affecting buyers and sellers. This is causing sellers to come into the market. Bond yields increase. And we are at a relatively high level. So all of a sudden there's a flood of sellers, and at these higher levels, there aren't as many buyers. But very quickly, as the drop-off reaches a significant level, the buyers come back in and there's no more sellers. There's a lot of transactions going on, it appears. Now, another issue, the fundamental issue that people can consider in this environment is the economy. Is the economy going to be weak? Are there reasons to be fearful of a less than pre-pandemic economy? And I do believe the economy may have less output, and most likely will, than the pre-pandemic economy. But there's some very important things to consider here. One, my biggest fear is the unemployment rate. But the unemployed are getting checks every week until September, it seems. In addition, they're getting another $1,400, which is a lot to those people who are unemployed. And they don't tend to spend all too much money. We want them to be good, but it is what it is. Next, the rest of the country is getting $1,400 stimulus checks, And finally, most importantly, savings rates are at all-time highs, which means people have money. And I'm under the assumption, and this is where the assumption lies, that when the economy reopens and it becomes summertime, people will start spending and the economy will have a relatively vigorous reopening. A lot of the unemployed will be employed in the hospitality industry, and the economy may not get exactly at the incredible levels of the pre-pandemic economy, but will be at relatively strong levels. And let's go back to what we were talking about at the beginning of this video. Inflation. If you have a relatively strong economy, relatively compared to pre-pandemic levels, although not stronger, but you have a multiplier, we've used this term before on this channel, a multiplier of inflation, you can justify stocks at their current levels. Yes, they are justified. So because of that, I would continue to look for stocks that you like that are pulling back, buy them or add to those positions. And definitely consider selling something if it's down, but still too expensive. You know, we've named names. So we've stayed out of mega cap tech on this channel. We also talk about Zoom and DocuSign. Zoom is a great business. It's going to be here for a very long time in a very important part of the world. Same thing with DocuSign. DocuSign is a great product and it will stay. But the stock price is very high. So I would stay away from that. That's the deal. Good prices. Market levels, in my opinion, are justified. The economy seems pretty okay given all the stimulus. And the market seems okay given the possibility of inflation. And we will see what happens from now. So until next time, peace out.